In this video, we're going to look at Cineplex. It's a Canadian company that operates movie theaters. What I do in my videos is I run my discounted cash flow model to figure out the real stock price of the company. I also look at financial ratios and compare them to its competitors. And I'm going to be showing you step by step the process as if you're doing it with me. Let's get started with the model. This company has a market cap of $532 million. And the stock price is $8.40. So if you wanted to buy one share, that's what it would cost. Next, we need the free cash flows. And that's how you value a company or an asset. You estimate the future free cash flows and then you discount that back to today's value. And free cash flows is the cash that's remaining after operating a business. Without free cash flow, you don't really have much of a business. Next, we're going to get the net income. That's profit and loss according to the income statement. Now I'm pulling the revenue, which are the sales for the business. It's important that the numbers are consistent, because if they're all over the place, it would make it really difficult to value the company. They look pretty good, although there's a negative free cash flow one year. So let's look at a capital structure of the company so we can figure out what discount rate to apply to the future cash flows. So they pay $30 million of interest on the debt, and I'm going to use the 2018 number because I think that applies to the current debt. Let's go to the balance sheet to see how much debt they have. They have $625 million of long-term debt. And that means they pay 4.9% interest on the debt. Interest payments are tax deductible, so let's get their effective tax rate. They made $48 million before taxes, and their income taxes were $11 million. The effective tax rate is 24%. That means their cost of debt is 3.7%. Let's figure out the cost of equity. We need the beta for that. That's how much the stock moves relative to the market. And the more volatile a stock is, the higher the beta. They're a pretty high beta at 1.94. The stock moves twice as much as the market. So that means their weighted average cost of capital is going to be a little higher as well. Let's go back to the financials because we need some more information. Because when we look at the ratios later, we need to know their current assets. That's $256 million. Let's get their current liabilities. This is how much money the company owes within the next 12 months. That's $590 million. And their equity, that's total assets minus total liabilities. That's also $590 million. Let's pull the EBIT, earnings before interest and taxes. They call that operating income on an income statement. That's $149 million. And we'll look at a capital structure. The cost of debt is 3.7%, and they have 51% of debt in that capital structure. And the cost of equity is 17%, and they have 49% of equity in that capital structure. So the weighted average cost of capital is 10.3%, and that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We did a terminal value, which is all years past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $570 million. Divide that by 63 million shares, and we get an intrinsic stock price of $9. They're trading at $8.40. They're trading at a 6% discount, so it's a buy according to the model. Let's see what Simply Wall Street says the company's worth. They're valuing them a lot lower, $3.18. So I think they're valuing them lower because they don't expect the movie industry to do well in the near future with coronavirus. Sales are going to be struggling. So they're factoring in the future. With my model, I just look at the past information. I don't really factor into the future. Although when I make my buying decisions, I will look into the future as well, not just into the past. Let's look at the historical stock price. So stock seems to be dropping quite a bit over the past 2 or so years. So it's at a really low point at $9. Let's look at the financial ratios of the company to get more information. They have an OKP at 18, that's price of stock over earnings per share. Really low price to sales ratio of 0.3, that's price of stock over sales per share. Price to book under 1 indicates it's a really good value of the stock, or it could indicate the balance sheet is not that good. Current ratio of 0.4, so they can't even cover half their current liabilities, so they'll need to take on more debt. ROE of 5%, that's income over equity, really low ROE. They have an interest coverage ratio of 5, so they can cover their interest payments 5 times. That's good. The best way to look at ratios is to compare them to similar companies. I've done videos on Disney, Discovery Channel, and Genius, and they're in the same industry as Cineplex, although they're American companies, but you could still compare the ratios. So if the number's in red, that means Cineplex is worse than the average. If they're in green, they're better than the average. So they're definitely worse than the average in price to earnings. The average is 2.1, they're 18. They're better than the average in price to sales and price to book. They're worse than the average in current ratio. The only reason they're better than the average in ROE is because Genus has such a big negative ROE, the average is negative for the industry, but 5% is not a good ROE. They're a little higher than average in debt at 51%. They're not too leveraged, so they do have room to take on more debt. And they're really small in terms of market cap. They're much smaller than Disney and Discovery Channel. So let me know what you think of the video. Would you ever invest in Cineplex? Thanks for watching.